Ladies and gentlemen, welcome back for our new session. Once again, I found myself rather disoriented. Earlier, I couldn't find the clock. This time, I can't find a fire. But this is supposed to be a fireside chat, and I can at least find the chattee. How do you do? Bill Winters, Group Chief Executive Officer of Standard Chartered. Please have a seat, Bill. Bill was just reminding me that in a corporate sense, he and I and The Economist are family. We share a founder in James Wilson, a Scottish businessman, economist, who actually, after having founded what was then Chartered Bank, I think, and The Economist, went on to reform the Indian financial system after the rebellion in 1857, and is buried in Calcutta. So it is very good to have a corporate family here. And very good to have Bill representing Standard Chartered, which in many ways represents an ideal bridge between our three themes today. That is the Gulf itself, where Standard Chartered has been here for 60 years. The future of finance, it is a bank. And emerging markets, it is predominantly an emerging market bank. And so welcome, thank you very much for joining us. And could I start with where we are? We had a session, which you may have caught earlier, on the Gulf finance, the Gulf region. How does it seem to you? I mean, the tone of the panel, if I may summarize it, was rather to be how to overcome some current gloom and achieve optimism. Where do you stand on that?
I think we'll focus on the optimism part, because we continue to see the Gulf region as an extremely dynamic one. Obviously, it's been through some difficult times and still emerging from those difficult times, but both economically with the oil price drop, but also politically with a fair amount of change and tension within the region. That's all quite evident. Despite that, there's an ongoing supportive investment climate. There's certainly, coming out of Saudi, a reform agenda which is potentially very exciting as that really gathers steam and unfolds. Have to overcome some of the political questions that are floating around right now. I'm not going to pretend to have answers to those questions, but if we can draw a line through a lot of the noise, which has always been evident in this region, in fact, most of the markets where we operate, there's always a pretty heavy dose of background noise, which does cause things to fluctuate quite a bit. The underlying economic story is quite attractive.
I mean, I won't spend a lot of time on the background noise, but it is a big event. In the short term, it's presumably extremely disruptive to your business markets. We've seen the oil price spike a bit after it. I mean, how much of a short-term reaction do you expect?
Well, very little, actually. So we've seen a little impact on our business and don't expect to see a lot of impact on the business. We have operations throughout the Gulf. Business is carrying on as usual. I think some of the reforms that are being played out, again, specifically in Saudi, could be quite supportive for business development. There's obviously hurdles that have to be gotten over. But in the meantime, it's business as usual for us and for most of our clients. And it's quite supportive. So our results in this part of the world have been good. And we're investing pretty heavily because we think they're going to continue to be good.
And broadening it out to the other markets where you're active, where are you most excited about at the moment?
Well, as you know, we have operations across the Middle East, Africa, South Asia, across ASEAN and North Asia. But between a quarter and a third of our business is in the Americas and Europe, for the most part with companies that have operations in this part of the world. So we could broadly say that most of our business is related to these emerging markets. But it's also truly global. And there's plenty that's exciting within the region. Start close to home. Dubai has obviously made a phenomenal recovery and ongoing growth story in the UAE more broadly since the financial crisis. This is very encouraging, and that's despite the drop in oil prices. Saudi, the reform agenda could be quite exciting, and I think we watch that very closely. Obviously, there's challenges right now, and we'll have to see how those play out. The Africa is always a mixed bag. I mean, we heard the governor from Kenya now, which was a super high-flying economy just a year and a half ago, It's still doing well, but there's the political noise is certainly clouding the picture there, and there's to be some important decisions coming out this week around whether these elections will hold. But I think that's the story of Africa. On the other hand, if we look back 2 years and looked at Ghana, you'd say that's a really challenging economic story. But the combination of election results, new government, the very, very robust reform plan, together with some IMF assistance, and that country is really set and poised for growth now. Nigeria is a couple years behind in its own recovery, but we'd say similarly, the outlook is bright. So we as a bank are investing pretty heavily in the Middle East and Africa, because we see, again, we try to draw a line through the noise, and the trend line is quite positive. We continue to be very supportive of and constructive on the reforms in China, and China is clearly an engine of growth for the world, biggest contributor to global growth, but also a very direct contributor to growth in the Asian region. China is taking every opportunity right now to fill the voids that are being left by the U.S. and to a lesser extent European countries, and they're doing it quite successfully. So
we'll certainly come back to China,
okay.
but to stay on Africa for a moment. I read in this week's Economist, so it must be true, that last year growth in sub-Saharan Africa as a whole was 1.4%, I think, the lowest level it's been for more than 2 decades. Do you see this turning around? I mean, is it just individual good examples like Ghana, or are there overall hopes?
No, I think there are great overall hopes. So the 2 biggest economies in the African region are South Africa and Nigeria, by some measure. Nigeria, we know, had an extremely difficult time in 2016 with currency fluctuations and controls, which really sapped the strength of the economy. That economy went into recession for the first time in decades. And South Africa is the other. The problems are more structural in South Africa, as we've seen. I think the fix will be harder to come by. But we all see the tremendous opportunity in South Africa over a period of time, and Nigeria is already getting back on track. It's certainly not fully recovered. But when the 2 biggest economies in the region, each for very different reasons, hit the headwinds, it's going to drag the numbers down for the continent. But around those 2 markets, you had recovering Ghana, in fact, recovering most of West Africa, following the oil price adjustment and following the Ebola virus. And the neighbors of South Africa are doing fine as well. I mean, Zambia is on the road to recovery. East Africa, as we know, we just talked about the Kenyan elections. That's a spanner in the works. But the growth dynamics in the rest of East Africa, including places like Ethiopia that haven't been on the international investing radar screen until more recently, are growing quite nicely.
Okay, let's turn to China, since you mentioned it. I mean, I suppose it's an economy where views tend to be drastically divided between bears who say that no country has ever expanded debt at this sort of rate and not had some kind of crisis, and those who say, well, China is different. It can manage it. Where do you stand?
Well, yeah, I think both the bulls and the bears are right. On the one hand, the underlying growth story is real. I mean, the economy, even if you strip out any sort of debt-related stimulus, is probably still growing at between 4.5% and 6% per annum, which for an economy that size is still an enormous growth rate and a huge contributor to global growth. And it's for good reasons. It's an economy that's continuing to urbanize, a population that's urbanizing. It's an economy that's shifting from being investment-led to consumption-led. And these are all supportive of that strong underlying growth. So the growth is real, and I think can carry on for some time. But of course, you're right. On the other hand, there's been an enormous buildup of debt, which has accelerated growth beyond what might be the more natural underlying growth rate. And we can all imagine why that is, what the particular either market motivations or political motivations were to grow that debt stock. The question we ask ourselves is, do the Chinese authorities understand the nature of their debt problem? And the answer is very clearly yes. Certainly from discussions with policymakers, they understand that they're getting into, having gone through the amber zone, approaching a red zone. Some will say they're in it, but the second question is, do they have a plan to deal with it? Can they manage the social tensions in an enormous country like China, that would be that would go along with a slowing of growth, which would go along with a reduction in leverage. And I think the short answer to that, again, is yes, they have a plan. They have, I think, a pretty clear plan to rein in the financial system, to steadily reduce the ongoing cash flow that's going into non-productive industries, obviously to do that in a sustainable way. So, they know the problem, they have a plan. Third is, do they have the will to do that? And that's the big question. I think very few people question whether they understand the problem or whether there is a possible way out. Do they have the will? And before the 19th Party Congress, it was hard to tell whether they had the will, because there was clearly a reluctance to pull the growth brake in any material way. Now that's behind us, and President Xi has established himself as the clear leader in the country for some time to come. And we'll be looking for the signs of whether they're prepared to take some of the difficult steps to rein in that debt stock. I believe that they will, but of course we're watching this very carefully.
I suppose for a year or more, people have been saying, well, nothing's going to happen before the Party Congress, have to wait till after that. Even so, we do see these signs like Zhou Xiaochuan, the outgoing central bank governor, voicing concerns that financial sector reform in particular is still going too slowly, that the government, as opposed to the central bank, is not really on board with that program, that it's more concerned still about stability than reform. You remain optimistic, huh?
I remain optimistic, in part because someone of Governor Zhou's status and stature can make that kind of a statement, which says to me that the debate is allowed to be had in public, and which sort of confirms the first premise, which is that the Chinese leadership understands the nature of the problem and that they've either have or are in the final stages of agreeing their plan for how to deal with it. I think if it was a no-go zone, you wouldn't hear Governor Zhou talking about it that way.
And to raise the other point you made about China expanding into the vacuum left by a diminution or withdrawal of American leadership. I suppose one sees that in economic terms through the Belt and Road schemes, through the various development banks it's launched. From your perspective as a banker, does that throw up lots of opportunities for you, or is it a land grab by the Chinese state, in effect?
Well, it may be a land grab, but that's history is made up of land grabs. This is fundamentally a good thing, I think, for the eastern half of the world, and is a good thing, therefore, for Standard Chartered Bank, because that's where we operate. There's all sorts of interesting questions around how the dollar will be used prospectively, and the dollar is still the dominant, overwhelmingly dominant global currency for trade and investment. We're the biggest clearer of U.S. dollars of any bank that isn't based in the U.S. So that's, we'll continue to have a real vested interest in the development of global trade broadly, trade in dollars specifically. But we're also the biggest or second biggest international clearer of RMB. The bulk of that RMB today is clearing China, Hong Kong, but we can imagine the RMB, especially now that it's achieved reserve status, taking a broader role in global trade, and that's something that we will try to develop alongside.
I think it's true, is it not, that the renminbi is actually being used less than it was a year ago?
So like everything else, I think in terms of the markets that we deal in, there's no straight lines. And the RMB opened significantly over 6 or 7 years. In 2015 into 16, took a big pullback, coincident with the entry into the SDR, which is interesting. Makes one think that there was an overemphasis in the prelude to that SDR status. But I would continue to make the bet that in the medium term, the RMB, the Chinese capital markets continue to open up. And as those capital markets genuinely open up, the currency will be used more frequently.
To move next door to another huge emerging market, India. In the previous session, there was some discussion of the bad debts within the banking system, which seemed to be a problem that is constantly about to be addressed, but never really is. Do you see hope there?
I do see hope, and we had our own share of bad debts in India in 2014 and 15, and we took action quickly in 2015 to resolve those situations. I think probably ahead of the pack. We were encouraged strongly by the central bank to be clear and transparent, and I'm sure part of the motivation by the central bank was to set the tone for the rest of the industry. The big problem for certainly the public sector of the Indian banking industry is that they were undercapitalized and couldn't absorb the losses that were on their books. The recent recapitalization plan announced by the Indian authorities goes a substantial way to addressing that, which should be the impetus, should give the market the impetus to resolve this problem that has been going on for too long. And we all know that failure to deal with a substantial block of non-performing loans in a banking system is the worst thing for the economy. We saw it in Japan. We were at risk of seeing it in China, but they've taken decisive action. And we just look at the contrast between the American recovery since the financial crisis and the European recovery. The difference being the Europeans largely failed to deal with their debt overhang until much later. So I think the Indians are well aware of the need to resolve the non-performing loan problem, and I think they're now taking the steps to actually clean that up.
I think there's also, as again was expressed in the last one, some general sense of disillusionment and disappointment in the Modi government's enthusiasm for reform more broadly, that the general sales tax as introduced became more complex than originally envisaged. The demonetization seemed somewhat half-baked. Are you optimistic about its capacity to steer the Indian economy through the next few years?
I am, recognizing that the GST rollout was really challenging, especially for small businesses. So I mean, real working capital challenges and hence production challenges. And the demonetization was an enormous distraction that doesn't seem to have reaped great immediate gains. Although I would say in both cases, these are relatively small investments to make to what would be considered basic reforms in most economies. You need to have a global, or at least in the case of India, a national across state boundaries goods and services tax system. I mean, it was absolutely necessary to have a single market. And there are going to be some teething pains, but that's okay. When you look at what the Modi administration has accomplished in their relatively short time, it's mind-boggling. I mean, relative to what happened in the 30, 40, 50 years preceding that, there's a tremendous reform agenda. Not everything has worked perfectly. Not everything has been implemented in a way that if you had it to do over again, you would do it the same way. But I think the intent is there. I'm sure there's some fatigue, both within the population, but also within the ruling parties. But I think that the underlying reform program and process is well entrenched, and I think it's quite encouraging for the long term in India.
Can we turn to the third theme of our meeting and a central one in your life, the future of finance? I mean, you probably heard a question raised in our first session this morning to the various investment funds on the panel about sort of, in a sense, are you history? Are you going to be disintermediated by technology? And I suppose the same question could be asked of banks more generally. Are you on the way out?
Or are you asking if I'm personally history?
No, your institution.
So I'm happy to say we're a really important part of history, but we're definitely not history. So I think banks will be around for a long time, but they'll be very different. And we already are very different. So I was in fact, I was in Dubai with my colleagues last week, and in the UAE, we now process over 98% of our transactions digitally. That's despite having an extensive branch network. That's a fundamental change. I mean, customers, all of you in this room, I mean, when was the last time any of you have been in a bank branch? Has anybody been in a bank branch in the last year?
I'm going to complain every now and then.
Well, okay. We love people like you.
I get fed up shouting at my laptop.
No, I mean, I didn't see any hands go up because people don't go into bank branches unless they absolutely have to. So if the people want to service their needs digitally. So that's already a huge change.
And I certainly haven't written a check for a long time.
My veterinarian now only takes checks, but apart from that, I haven't either. But this is a big change, and banks manage that migration from a cash and check society to a largely a digital financial society, and we're still here. And so there are great threats from e-commerce players. People talk about fintech. I know there's a lot of discussion of fintech earlier today. The fintech, the people that are building financial technology are working with banks. The biggest spenders on fintech are banks. Right? Our budget for fintech type applications is $700 million, which is 8-9% of our total expense base. So I mean that's the amount of money that we're spending on fintech, and we're a reasonable sized bank. Dwarfs most of the fintech investment that's happening in London or in Silicon Valley, and obviously it's the same for every other bank. The e-commerce companies are different. The e-commerce companies are not working with banks; they're competing with banks. They have the advantage of a much broader customer base, and they have the advantage of really outstanding data analytics. So for banks to survive, we're going to have to provide our customers with something incremental to what they can get from Alibaba or Google or eBay, and that's I think banks are rising to that challenge. Banks also serve a societal purpose. There's an element of what banks do that is utility-like, and for that reason, we're very heavily regulated, and that regulation is a pretty big barrier to entry. So I don't think most e-commerce companies want to deal with the issues of being a regulated bank. So long story short, I think banks are going to be here for the long term, but banks will have to adapt, as we have.
So this gives me the alarming sense that nobody's heard a word I've said for the past 2 minutes. But you at least heard the questions. But could we see if there's anybody in the floor from the floor who would like to ask a question? There's one at the back there, please, if you could have a microphone.
Hello, this is Walid from Union National Bank. First of all, thank you for your valuable information. I want to discuss with you about Africa. You mentioned the two largest economies are South Africa and Nigeria, where IMF mentioned that the second largest Egypt and expected to be the first one within the coming 5 years, and the latest S&P positive outlook about it. So what's your opinion about it? What's your vision? And do you have any expansion plans within Egypt, which is the second largest in Africa and the second largest in the Arab region? Thank you.
No, you're absolutely right. I should have qualified my comment to sub-Saharan Africa, but of course Egypt is the other relative giant on the continent. We have a substantial business in and around Egypt. We're not in the retail business on the ground, but we do our corporate banking actually from Dubai, and we're very happy with the ongoing reform agenda in Egypt. It's been obviously a particularly difficult time for the Egyptian economy. Captured by the currency volatility and the depreciation of the currency, that it certainly takes the wind out of things. But we think that there's an underlying economic reform agenda that's encouraging. So we're absolutely looking to continue to build our business in Egypt.
Another question in the middle on the right there.
Mr. Witness, thank you very much for your presentation. You alluded that the banking is going through a major transformation and the challenges are growing and you have to adapt. Can you share a bit of your views about any fundamental changes in the way the traditional payment system is taking place, and particularly highlighting the role of cryptocurrencies and if that really poses a threat for the traditional banking system going forward?
I'm very glad you asked that, but could you identify yourself, please?
Excuse me?
Could you tell us who you are?
Yes, my name is Apostolos Bantis from Commerzbank.
Thank you very much. Cryptos.
Yeah, I think there's kind of effectively two parts to the question. One is there a future in cryptocurrencies, which really is getting to the question of whether we can trust central banks anymore. And the second is there a fundamentally different payment platform that will obviate the need for the current infrastructure that we have today? And the obvious alternative would be a distributed ledger technology-based payment system. In the second case, I think in the medium to long term, it's almost an inevitability that we'll be using blockchain-type technology to facilitate payments. We'd go from T plus something to real time with mutually verified records in a safe environment. I think the really interesting question is how do governments stay involved in the payment systems in a distributed ledger technology world? Because I have no doubt that they will stay involved. I think there's no possibility that the bulk of the world payments will take place in a way that central banks or law enforcement authorities can't take a look in. As soon as they have a look in, there's a backdoor into the system which could potentially corrupt the distributed ledger itself. So there's a problem, there's an opportunity. the industry together with government and law enforcement will work that out over some period of time. I don't think it'll be easy and it won't be perfect, but I think it's inevitable.
Bill, could I just ask you to stick your neck out and say, I mean, you say it's inevitable, but how long do you think before distributed ledger technology goes mainstream for payments?
Well, for payments, I think it'll be a very long time, because I think the stakes in terms of some level of ineffectiveness, either in the security regime or transparency, the stakes are so high that I think it'll be a long time before mainstream payments go distributed ledger, which is why cryptocurrencies exist. It's the anonymous alternative to conventional payments, which I think law enforcement and governments will allow as long as it's very small, and will absolutely crush once it gets large. As we all know, and many of my colleagues in the banking fraternity have noted that the primary use for cryptocurrencies today is criminal, and it's not the only use, but it's the primary use, and that's never a good basis for the establishment of a market. That said, the idea that you've got something that's independent of government intervention is clearly desired by groups of people, and there's going to have to be a happy medium found where we can have the benefits of an objective value point that at the same time is accessible to law enforcement to fight crime.
Thank you very much. I'm afraid we're out of time, and I'd like to thank Bill Winters very much for taking part in this fireside chat without a fire, and for presenting such a convincingly optimistic case on all three of the themes that we're supposed to be discussing today: the future of this region, the Gulf and finance here, the future of emerging markets more generally, and the future of finance insofar as it involves banks like Standard Chartered. Bill Winters, thank you very much.
Thank you.
Now, my chance to hand over to our next moderator, Willem Marx from CNBC, who is kindly going to moderate a panel on regional trade.
Thanks so much. I'll hold on to that just for safety. Hi, everyone. My mic is working. If not, I will use this one. I am a reporter at CNBC, as Simon mentioned, and I'm going to be talking with three panelists I'd like to invite up now, if I can, about regional trade. I spend my life asking questions, and it would be great if some of you guys wanted to ask questions at any point during this discussion. Just put your hand up if there's something you think you want to know more about from one of our panelists. Alicia, would you come up as well? Saugata? Don't be afraid to put your hand up and we'll get a microphone to you, identify yourself, and ask the question. I am joined on the stage here by three people with very interesting but different perspectives on this subject. It's a real pleasure to have you guys here, frankly. I'm going to start from the far end. Saugata Bhattacharya is from Axis Bank in India. He's chief economist there. And I think we'll be focusing largely on India's role in regional trade and opportunities there. Kevin Sneader, nearest to me, is chairman of Asia for McKinsey. And Alicia García Herrero is the chief economist for the Asia-Pacific region for Natixis, which is a French bank. I want to start with you, Kevin. Talking about regional trade, I spend a lot of my time reporting on Brexit, but having lived in the US for many years, reading about the Trump administration. And in their own different ways, the UK and the US have both turned inwards in some senses. Just today, the British Parliament is looking at how it's going to handle the withdrawal from the European Union, and the British government is, of course, on the lookout for trade deals. Meanwhile, we hear from President Trump and his Commerce Secretary Wilbur Ross, their questioning of the primacy of the WTO. They have obviously withdrawn from Trans-Pacific Partnership, and they're threatening to, tear up NAFTA. And I wanted to ask you, given the changes to trade flows and trade patterns away from global sense to much more regional focused movements of financing and goods. I wonder, is it the end of the system we've seen for the last few decades, the very liberalized system?
Okay, so this is where we get to be pessimistic for a moment or two and put some dampers into the room. It's also where I remind everyone I'm Scottish, not British, so just keep that in mind. We have a slightly different view in this whole Brexit nonsense. But anyway, if you want to go looking for pessimism, you can find it in the agendas you've just shared. It's clearly the case that global trade, in fact, if you look at goods and services, as a proportion of GDP, has actually shrunk. So it used to be 54% of GDP, now it's down to about 39%. Global trade in all but this year, and I'll come on to that in a moment, has lagged GDP growth when it comes to physical goods and services. There is lots of rhetoric about the end of global trade agreements with some cause. And I don't know how many of you are familiar with something called a handbrake turn. When I was learning to drive, the handbrake turn was a really exciting thing. You put your foot in the brake and you pull the handbrake, and the car starts spinning. And I was very struck by a comment a former Director General of the World Trade Organization made. He said, you've got to remember that global trade agreements involving huge numbers of parties are really very simple when you think about them. They consist of an accelerator and 153 people, the members of the WTO, each of whom holds a handbrake, and at any point in time can put that brake on. And here we are today talking about the fact that a couple have chosen to put the brakes on. And that's the basis for the pessimism, what you shared about Trump and what you shared about Brexit. But it's also worth remembering a few other facts that play in the opposite direction. And they include the following. First and foremost, we live in a world where actually the physical goods and services are a lesser part of what's really going on. Bill Winters just talked about the digitizing of his bank. The digital flow has never been greater and will continue to multiply at enormous rates. It's increased by about 45 times just over the last 5 years. And there's no sign of that stopping in terms of the amount of data being shared globally. If we actually look at trade agreements, well, you know what? The boat keeps leaving the port without the US. So this week, you will all have seen in Da Nang, and we can debate the merits of it, but essentially the TPP-11, who were left behind by the United States, are moving forward with something they're calling the Comprehensive and Progressive Agreement for Trans-Pacific Partnership. Yes, it doesn't include the United States, but you know what? There's more to trade than just the US. And at the same time, we also have China and what it's trying to do. And we will, I'm sure, debate the Belt and Road Initiative, and I'm sure we'll debate whether or not their Regional Comprehensive Economic Partnership, the RCEP, which involves 16 countries, is actually something which proves the counter to what you just set out. But I think there are as many pointers that suggest global trade will continue. It just may not have quite the liberalizing tone that we've had, and it will be different to what we've known. So the trade that we've had will continue to globalize because I don't think we can stop the digitizing and the flow of non-physical goods and services. And we are going to see regionalization where we're seeing globalization. But perhaps we'll save that comment for later.
Alicia, how optimistic or pessimistic are you about global trade flows at the moment?
Well, I quite agree with what I've heard so far. But I would add that one of the optimistic sides, just to focus on that at the beginning, is really the Belt and Road. We've conducted an empirical study as to how much more trade would be created out of the Belt and Road Initiative. And that was a win-win for the world, actually. In the very specific case of Europe, which is basically the end of that belt, not that road, it would be a 6% increase in global trade for Europe for the mere fact that you basically have better transport infrastructure for free. I mean, somebody else might pay for that. So, you know, I think Belt and Road is, in a way, something that we tend to forget about when we talk about trade, simply because it's not a free trade agreement so far. And it's just a logistical, for the time being, a logistical endeavor. But logistical endeavors are important for trade. And that is one of the positive aspects. Of course, some other regions of the world may benefit the least, which doesn't mean it will be negative. According to our analysis, that would be the US, Japan, which would be kind of left apart of this win-win. But overall, it's a win-win for the world. Some will benefit more than others, and we can imagine who will that be. But other than that, I think that is a positive for global trade. If I may add just a little point, though, is that we focus a lot on trade of goods, That's why we build this massive infrastructure, of course, ports and railway in particular for the case of pipelines, gas pipelines for the Belt and Road in particular. But we tend to forget that the bulk of the growth in trade today, so the marginal increase is actually services. And I wonder whether we're all focusing too much on hard infrastructure rather than focusing on how to increase trade in services. And that's where soft infrastructure is needed. And I think we should a little bit switch to that. And it might well be that doesn't have to be necessarily multilateral endeavor. So just a point of attention that yes, we have the Belt and Road, that's great, but a lot of the trade will be in services, and I don't think that platform is built toward that service mindset yet. It might become so, but it's not yet the case.
Saugata Bhattacharya, talking of how you distinguish between the different aspects of trade and the elements that are being traded across borders, how does a major institution like the World Trade Organization or different countries treating with each other bilaterally embed things like capital flows into trade agreements?
I think it's very important. So let me preface this by a remarkable statistic that I just saw recently coming in from the Bank of International Settlements. In about 1950, about 49% of children used to earn more than their parents. By 2011, I think, it's come down to 10%. It dropped like this. That tells the story of why people are disillusioned in this arrangement of globalization. I think to address your question of capital flows, I mean, in this context, take India, for instance. I mean, we are a growing economy. I mean, we need massive pools of capital to finance our infrastructure, to our capabilities, etc. So we need access to global funds. On the other side, I mean, we are growing at 6.5%, 7% or whatever. So, I mean, you have a large need for consumption. India is actively looking for its Make in India program, say, for instance, so inputs into this. So how do you finance this? So to maintain a sustainable current account deficit, which is a must for macroeconomic imbalances not to crop up in the system, you have to look at trade in the context of capital, investment, IP, labor, I mean, a whole bunch. I mean, it's a comprehensive look. I mean, it's no longer trade anymore. And as Alicia says, it's not just goods. Jet engine makers don't sell jet engines anymore. They sell the whole package as services. So, I mean, you have to look at this package in terms of integrating with global value chains, not just trade in itself. So capital flows, investments, is actually getting more and more embedded into trade flows.
Kevin, let's talk about Asia. I mean, that's what you focus on. Sure. It's been a bright spot when it comes to trade agreements. Do you think that will continue, whether we have this focus on embedding these issues into these agreements or not?
No, I think it will continue. If you think of Asia, there are something like 150 regional agreements concluded in the last 20 years. In the prior 40, there were 50 concluded. So there's been a massive step up in regional agreements as relate to Asia. And the intra-regional trade within Asia continues to grow enormously. It used to be, it was very small, it was about 15%, now it's up to 35%. So there's been a step change in the amount of trade that Asian countries conduct with each other, but there's still a ways to go. That 35, if you draw the parallel with the European Union, should be closer to 50, 55%. The good news is Asian countries are exporting beyond the Asian borders, but they still have a lot to do within the region. So you're going to see a lot of agreements that are actually intra-regional, and that's why Hong Kong last week concluded an agreement with ASEAN. We're going to see more of that just happen. There's still a lot of barriers and boundaries that need to be removed to promote the free movement both of goods and services and digital flows within the Asian economies. Asia itself will continue to power the world's growth. We've already heard that this morning in many of the contributions. And because of that, the agreements outbound from Asia with the rest of the world will also continue to increase. ASEAN has a fairly full agenda in terms of agreements it's trying to conclude. And of course, China is architecting its RCEP. And the RCEP will include a number of Asian and non-Asian countries too. So it's got the ASEAN +6. So it's got Australia, New Zealand, China, India, for example, being an important part of that. The one thing that I think we need to be aware of, though, is what's in those agreements. So I think IP will continue to prove a major stumbling block. If you actually look at what the countries who have signed up to move forward with the TPP, now renamed, the clauses they removed or suspended are all related to IP. And they know that will be the sticking point. And so I think it is true that it's an important conversation that needs to be had, but it could be a major barrier to getting some of these agreements concluded. And therefore, I think you'll find we're going to see things that look more like the RCEP, which is a lot less about IP. And frankly, what America has really done by stepping away from TPP is ensure that the things America was fighting to include, namely protection for IP, are not going to be part of these agreements. And then the world is going to be left with a choice. You can do business with the part of the world that will power the world's future growth on its terms, or you can just watch. It's unfortunate that I think that at the moment the choice seems to be we're just going to watch. That seems silly. But let's not think that the type of agreement is necessarily going to embrace the kind of things that, for example, were part of the United States' agenda when it was trying to influence TPP.
Alicia, when you see the US step back from engagement in some of these issues, and you see a country like, let's say, Vietnam striking a deal with a bloc that includes Russia, Kyrgyzstan, Kazakhstan, Armenia, and Belarus, they're not natural bedfellows in anyone's mind. But are we seeing a whole new global paradigm when it comes to trade?
If you refer to Vietnam, what I see is a very pragmatic and clever country because they've already signed free trade agreements with China and the EU for that matter. So, it's basically telling the US, you're not happy with renewal, bye, that's what it is. So and that is the theme that I don't think, I very much agree with your point. It's not even about the paradigm, it's I need markets. If you're ready to accept my conditions, fine, otherwise I look elsewhere. And that's what China is doing as well. So, and by the way, and that's where the demand is, let's face it. That's where the growth of the population is. That's where Vietnam's value-added goods will be sold, not in the US in any event. So why not? I just think that's a very clever way to go about it. And they have enough developed markets, i.e. the EU. They still have to ratify that one, by the way. It's increasingly difficult to ratify stuff in the EU, but that's a different topic. But again, that will only tell them, why bother? Why bother? Let's go elsewhere. Let's do it quickly. Let's find the markets for our type of products, for our target, for the value added we can offer now. And so, in other words, Vietnam comes to this world, 20 years after China? China depended on the US and Europe. Vietnam doesn't have to depend on Europe and the US. It's a different ballgame, and they've gotten that right.
I agree with that, because it's worth remembering some numbers here. If you take ASEAN exports 20% to China and imports 22%. The numbers for the US, 6% and 10%.
Yeah.
This is not a story about the US. The US has an option to participate or not, but actually it's a fraction of the scale of the trade that China is doing with ASEAN. Now, that's just ASEAN if you want to talk Vietnam and so on. But it is sometimes we lose sight of where the power actually sits in some of these geographies. Now, there are other markets where, of course, the United States remains the dominant force in world trade, but not in this part of the world.
Saugata, I wanted to ask you about India. Do you think that they play a significant enough role in global trade compared to a China these days?
Definitely not. I mean, the numbers show that clearly. I mean, China's share of world trade is 14%, India's is probably 2%. But remember that a country like India, I mean, at the stage of development that we, India, are at, I think the focus should be and is on building up domestic infrastructure, domestic capabilities, etc. But that doesn't mean that we are not playing a significant role. India, the UAE is India's largest trade partner already. We have massive energy needs. So, I mean, moving in from oil and gas, from investments in oil and gas, all of these are beginning to work. And look, the way the world is moving now with technology, with regional groupings, what we see now is the old models of the diminishing returns to scale being increasingly moving towards increasing returns to scale. So you're beginning to build groupings according to the economics that drive the groupings, that drive the maximum amount of returns on the increasing returns to scale. I mean, each country, each grouping will have different needs. Smaller countries will need groupings, will access to other markets. A market like India will essentially have markets, in the early 20th century, the biggest drivers of productivity in the developed markets were things like electricity, transport, education, female participation. India is at a very, very early stage of evolution. So we can afford to have things moving up, our productivity increasing by looking at ourselves, but essentially looking at other parts to drive the value chain in India. So I think stories would be very different between the developed markets, the emerging markets, within emerging markets. There would be different stories in the ASEAN, in the Middle East, in the Eastern European countries. And so that's an indirect way of addressing what you were saying.
I suppose that's a good point to bring up the Belt and Road Initiative. You talk about linking these different markets together. And Alicia, let's start with you. I mean, how significant is it? Is it really going to be the success the Chinese want it to be?
I think it will. I've thought about this for years already, since it was announced in late 2013. And I happened to live in Hong Kong, where 4 years nobody paid any attention, and they all thought, well, that's just propaganda, and
Go away.
and who knows what's going to happen. And I guess they felt slightly uncomfortable,
right,
because Hong Kong was kind of the center of all of that process trade, and they saw the role vanishing, and frankly, they didn't want to take the opportunity as it came. But from that perspective, I always thought, well, that this is something that won't fade because it makes sense. I mean, the whole idea why I think it will succeed, it's because it makes sense. It's just, if you look at any map, there was a hole, if you think about the belt, i.e. the landlocked part of the Belt and Road, kind of a hole. I mean, in a way, if you think about it, it's a massive population that was not really integrated. So in that regard, I think this will be a successful endeavor. It will be very costly. Belt and Road Summit, as you probably remember, in May, the figures that were in the room were of the order of $8 trillion in investment. So anything of that sort has to be financed in decades. It's not a yearly project or anything like that. But we already see some of the key themes. So far, divested is Russia-Pakistan. That's what we see, Russia-Pakistan. So you already see what's coming. We already see dreams of cities, say Gwadar, Dubai. We see where they're heading. They're heading to creating spaces that did not exist, but which make sense geographically, strategically for China. And those who want to take the opportunities will benefit from that. So it will be tough because it's a one player. This is not a multilateral endeavor. This is a one-to-one endeavor. And you know who you're playing with. So, chances are that it will be tough for you if you're on the other side of the negotiation room. But other than that, I think it makes sense. It will make sense for China to create its own area of standards. Again, this is not about trade only. This is about standards that are recognizable beyond your borders. That's what the Belt and Road is about, let alone excess capacity. That might be only the beginning of the story. You can't build something for 30 years to dump excess capacity. This is just the beginning. The story is very different. It's about standards, creating your markets which understand you, recognize you well beyond that simple excess capacity thing that people have focused on. So again, successful, in my opinion, down the road, costly, basically a tree, China in the center, everybody else fighting for China's investments. So the sooner you see it, the better, because if you're last, your negotiating conditions will be worse than anybody else. And that's what it is. And it is affecting this part of the world massively.
Kevin, given the huge sums of money involved, the challenge, of course, is to get private sector buy-in, isn't it?
Well, let's talk about that. So depending on who you believe, the numbers the Chinese often talk about is $4 trillion. To put that in perspective, $4 trillion, the Marshall Plan, the reconstruction of Europe, was $135 billion in today's money. So what's 40 times, enormous multiple of the Marshall Plan, 40 times bigger, something of that order. And to pull that off, you need to believe a few things. You need to believe that politically it's viable. I'm not a politician, so I don't particularly want to get into that, but it's very interesting to watch China and India as India watches all this capital flow into Pakistan, and, there's some tension there. It's very interesting to watch the reaction in Africa as to whether this is a sophisticated form of colonization or a genuine source of capital that should be applauded and embraced. So there is a political dimension, however you look at this, that needs to be considered, but let's put that to one side. On the economic side, the funding for this is being secured through a number of sources, not the least of which is the creation of a number of financial institutions, notably the Asia Infrastructure and Investment Bank. Again, let's just understand where we start from. The AIIB does have 65 members. It also has some staff between 70 and 100, with the goal of having 300 in 3 years. That's not a lot of people, especially when you think of the ADB, the long-established Japan-US-led bank in Manila, has 3,000 people. So the numbers are big, but the practical forces on the ground to go and deliver it, that's not that many people. So the talk is good, but we've yet to see it really result in the infrastructure that's needed to be able to deploy these sums of capital. And you need to make sure the money is well spent. So there is a real bar, I think, that's going to start to appear around the kind of projects that are backed. The first two things that the AIIB was able to back were two IPOs of Hong Kong-based companies who were, quote, involved in One Belt, One Road. That's not really what we're talking about. There have been activities since then, notably in Pakistan and a few elsewhere. But there's a lot of work to be done between those ideas and making sure they are economically viable. Otherwise, this will just be a form of FDI of an enormous scale. So you can point out all the obstacles, but then you do step way back and you say, is there a need that's being addressed by this project? And the answer to that is a big yes. There's a need in several grounds. The countries that are embracing this, and there are many, whether it's Malaysia or Pakistan or others, need the investment. They want the investment. They want the infrastructure, and they're prepared to accept some of what goes with that. Secondly, how much does the world need in the way of capital spend on infrastructure? And we're talking trillions of dollars. Somebody's going to have to provide that. And if the Chinese are stepping up to create a vehicle to do that, do we cast doubt in it, or do we say at least somebody's stepping up to do something? You probably go more in the camp of at least they're stepping up. But I do think we need a Belt and Road 2.0, to coin the sort of digital phrase, because 1.0 looks economically almost impossible, and politically, I think, difficult, because the backlash has started. Just Google and you'll see there's lots of comments about how this is being manifested on the ground. So Form 2.0 has to have more than just China. That's a big ask, but it does have to have more than just China. It has to ensure the projects have some basis for their economic success. So I'm not going to speculate as to whether all of the projects, for example, in Pakistan have that, but it would be an interesting test to go through. Do they have economic viability? How are they going to ensure there's a return here? Because for all the money that China has, it hasn't got enough to self-fund all of this. Certainly not given its current economic situation. And then the third part is, practically speaking, where are the people going to come from who are going to make sure this gets deployed in a way that is successful, country after country, project after project? So the rhetoric is wonderful, the need is clear, the reality requires a remake on where they've started. But I wouldn't bet against the Chinese. I think they get that they need to do that remake, and I think already Beijing is talking about that. And if you look at the 19th Party Congress, the one thing they spent a lot of time on was this. So this is very seriously high on the agenda of an ever more powerful President Xi, and I don't think we'd all bet against him making something happen.
So let's talk about those political challenges outside China then, and talk about India and these political obstacles. Is there a chance that the Indian private sector can get involved in One Belt, One Road?
It is. I mean, there is. We heard this in the morning as well. I mean, it's essentially a matter of risks. Private sector participation is a matter of a combination of capital allocation and risk management. So as any CFO in the room would tell you. So as in all public-private partnership projects, and we heard that in the morning as well, I mean, it depends on the balance of risk. Look, at the end of the day, trade, investments, the question is, how do we get growth going? I mean, global growth moving, whether it be investment, whether it be trade, or whatever, I mean, whichever So again, I mean, drawing an analogy from what we saw in what we heard in the morning, I mean, the essence of technology, that there are partnerships involved and returns to scale and the ability to customize. So I think all of these groupings, I mean, the same principle applies to global arrangements. So what groupings form, how public-private partnerships form, how private participation drawn. It depends on the individual context. And what Alicia says is very important. I mean, the role of these agreements is essentially to bring in an element of standardization in something which is intensely bilateral. So that's one. I think the other major part, other than infrastructure, which is needed, I mean, I think the world needs infrastructure. India, forget about it. I mean, India's needs for infrastructure. I think the role of SMEs, the small and medium enterprises, is likely to be very, very critical in this entire game. What are the global agreements that bring in the SMEs? I mean, we heard panel after panel say jobs. That's the biggest headache for all policymakers. So how can trade bring in more trade finance, more capital, more innovation into the small and medium enterprises segment? And I think that's where I think the role of technology that we are seeing now, forget about trade for the time being, and trade actually increases competitiveness in this field. So the role of SMEs and the ability to bring in more capital into SMEs, global capital, local capital, interregional capital, etc., I think will be very, very critical to the way that we see global growth going forward.
Alicia, one final question on this in relation to the Middle East. A significant chunk of that money that China's promising has come or will come to Middle Eastern countries. Is that representative of China's relationship to the region?
Okay, so if I may, I want to add a little bit on the financing first, because I just want to point out that, rightly so, AIB is a drop in the ocean. And not only that, they have paid up capital plus another 50 billion, they say max 100 billion in capital. But the point is, it's not the AIB that is going to finance the Belt and Road. Let's face it. They've only disbursed less than 2 billion so far. But the actual disbursement of China Development Bank, Exim Bank, China's major policy banks is, 100 times bigger? They are doing it themselves, let's face it. And I'm not sure they want the rest of the world to finance these projects. They may, if no questions asked. That's the point. These are their projects. These are their companies. And we need to understand what the rules of the game are. So this is not a multilateral endeavor. If we only focus on the AIB, it will look as if the project were not financeable. But the point is, they're doing it themselves. And they're doing it themselves in some cases even in renminbi. They don't even need all of these many dollars that we think, I mean, for some projects, obviously, but if you look at the last loan, China Development Bank, 11.5 equivalent, US dollar equivalent in renminbi to Russian Development Bank. I mean, that's what they're doing. And it makes sense because they're paying back to their own companies. So what I'm trying to say is that it looks as if it's massive and impossible, but as long as they finance it themselves, and increasingly with their own currency, it becomes more possible than we think it is. And that is something to realize, that as we move on, and of course there will be lots of things that are not good investments. I fully agree. But the bar is low. That's the point I want to make. The bar is low because return on assets in China today are barely 1%. So the choice for China Development Bank is either you dump money in China with a very low return on assets, or you dump money elsewhere with maybe higher return on assets.
How about the Middle East as a place to dump their assets?
Yeah, and the Middle East is part of this idea. So Middle East, I think is a very interesting story because the numbers are bigger than we think. Now, most of the figures, so the Middle East is the third largest region receiving money from the Belt and Road after South Asia and, of course, ASEAN. South Asia because Pakistan is in South Asia in the statistics. If not, it would be, if Pakistan were considered Middle East, it would be by far the second largest. Now, the difference between ASEAN and the Middle East is that here they do project finance. They don't buy. So Europe, US, and ASEAN is basically a lot of FDI. Here's project finance. They lend to the region. And that's a big difference, because when somebody lends, you know that, they not necessarily are here to stay, and you need to pay back, yeah? So, and it's mainly energy, utilities, and transportation, logistics. That's what they are doing. This is very different from the rest of the Belt and Road. So my warning here is that the financing to this part of the world is very concentrated in very few sectors, and it's loans. So if I were sitting here, I would try to diversify that away. I would try to expand the sectors in which the projects are being financed, and I would try to get more FDI from the Chinese. That would be my looking at what they're doing elsewhere, my advice, yeah.
On that note, I'm just going to open this up to questions from the floor. Do any of you have any questions for the panelists? If you do, please raise your hand. I can see one over here. Just wait for a microphone to get to you, sir.
Good morning, everyone. My name is Nicholas Gilani, Arjan Capital. I think this topic is quite prescient and important. I have two comments or questions. The One Belt, One Road policy or initiative, the question is how much of these monies, whether debt or equity, is going to be denominated in US dollars or in the Chinese local currency? Because if it's US dollars, essentially the US without its involvement is going to benefit. And number two, why is India straddling between a US sort of a free trade initiative versus being fully part of the One Belt, One Road? Thank you. And by the way, the Chinese in this part of the world, they seem to be doing a lot of EPCF. In other words, they're going to do the engineering, procurement, construction, and financing on their own part. Thank you.
Alicia, do you want to answer that first question about dollars versus renminbi?
Well, I wish I knew, because we have general statistics on renminbi financing, but we don't have it for country by country, so we can't really tell how much of the Belt and Road financing is in renminbi, I'm afraid. My sense when I look at settlement data by country, which is everything I have, so it doesn't have to be project finance, or I don't have that data, is that the more the country is captive, i.e. depends on China, the more renminbi settlements or renminbi financing there will be. I give you a hint of what I mean. Paris is the second largest renminbi settlement center in Europe after London. That's very strange, because Germany has 4 times more trade with China than France. Why? Because Africa settles in Paris. So you can already tell that the more you depend on China, the more willing you are to accept renminbi, both for financing or for payment of exports. And I think that's the way. I mean, the more you become dependent, the more this will be the case. So it might not be very important now, but it will become over time on Belt and Road geographies, yeah.
Saugata, do you mind taking that question on India?
Sorry, I didn't get why is India straddling the US and?
And the One Belt, One Road initiative. Why is it not taking a clear decision between the two? So
I think, again, it's a matter of investments. Wherever we get cheap money, any country, not just India, will get that money. So as you know, Japan and the Middle East, there's something called the National Infrastructure Investment Fund in India, which is using Middle East money, particularly right now, the UAE, particularly Abu Dhabi, and looking to broaden the investments. So I think the US, shorn of the political dimensions of the relations of the OBOR, the BRI initiatives, I think that, again, as I said, the focus is domestic investment. So we need we need to access global pools of capital. And the money that is now coming in from Japan for India's bullet train projects, for the dedicated freight corridor projects, for other projects, I think, that makes sense, essentially. I'm sure, if there is some Chinese companies are coming in and investing massively in India. India's telecom sector has seen massive Chinese investments. But as of now, I think we see limited potential for the BRI to come in. And coming back to the original question, I think Indian companies are investing in project finance in the Middle East, say, for instance. So private sector will automatically step in where they find that there are suitable risk opportunities for investments.
Any other questions from the floor? I can tell that people are hungry because lunch is fast approaching, so I think we will wrap it up there. Thank you to all three of my panelists, Kevin, Alicia, and Saugata. Very much appreciate your time today. Thank you all for watching.
Thank you.
Ladies and gentlemen, welcome back for our new session. Once again, I found myself rather disoriented. Earlier, I couldn't find the clock. This time, I can't find a fire. But this is supposed to be a fireside chat, and I can at least find the chattee. How do you do? Bill Winters, Group Chief Executive Officer of Standard Chartered. Please have a seat, Bill. Bill was just reminding me that in a corporate sense, he and I and The Economist are family. We share a founder in James Wilson. Ladies and gentlemen, welcome back for our new session. Once again, I found myself rather disoriented. Earlier, I couldn't find the clock. This time, I can't find a fire. But this is supposed to be a fireside chat, and I can at least find the chattee. How do you do? Bill Winters, Group Chief Executive Officer of Standard Chartered. Please have a seat, Bill. Bill was just reminding me that in a corporate sense, he and I and The Economist are family. We share a founder in James Wilson, a Scottish businessman, economist, who actually, after having founded what was then Chartered Bank, I think, and The Economist, went on to reform the Indian financial system after the rebellion in 1857, and is buried in Calcutta. Ladies and gentlemen, welcome back for our new session. Once again, I found myself rather disoriented. Earlier, I couldn't find the clock. This time, I can't find a fire. But this is supposed to be a fireside chat, and I can at least find the chattee. How do you do? Bill Winters, Group Chief Executive Officer of Standard Chartered. Please have a seat, Bill. Bill was just reminding me that in a corporate sense, he and I and The Economist are family. We share a founder in James Wilson, a Scottish businessman, economist, who actually, after having founded what was then Chartered Bank, I think, and The Economist, went on to reform the Indian financial system after the rebellion in 1857, and is buried in Calcutta. Ladies and gentlemen, welcome back for our new session. Once again, I found myself rather disoriented. Earlier, I couldn't find the clock. This time, I can't find a fire. But this is supposed to be a fireside chat, and I can at least find the chattee. How do you do? Bill Winters, Group Chief Executive Officer of Standard Chartered. Please have a seat, Bill. Bill was just reminding me that in a corporate sense, he and I and The Economist are family. We share a founder in James Wilson, a Scottish businessman,